Welcome to VeriScope News. We provide verified reporting and clear context. Our goal is to deliver neutral, calm, and factual information on the stories shaping your world. This is a deep dive into the current shift in Federal Reserve policy discussions. Interest rates are the most fundamental tool for managing a modern economy. They determine the price of borrowing and the incentive for saving. When the Federal Reserve adjusts these rates, the effects ripple through every corner of the financial system. For the past several years, the focus has been on raising rates to combat inflation. Now the conversation is shifting toward how quickly and how deeply those rates should be lowered. This transition matters because it signals a change in how officials view the balance between price stability and economic growth. Federal Reserve Governor Stephen Miran has provided a specific roadmap for interest rate cuts in 2026. In recent interviews with Bloomberg and CNBC, Miran stated he is looking for a total reduction of 150 basis points this year. This is a more aggressive stance than he had previously signaled. Miran argues that underlying inflation is now within the noise of the Fed's 2% target. Specifically, he estimates underlying inflation is running at 2.3%. Because of this, he believes that current restrictive rates are no longer necessary to cool the economy. His comments coincide with a push from the Department of the Treasury. Secretary Scott Bessent has also called for lower rates, arguing they are the missing ingredient for stronger growth. Miran's term on the Board of Governors ends on January 31st. His current position is unique because he is also a top economic advisor to the executive branch. To understand the significance of a 150 basis point cut, we must look at where rates have been. The federal funds rate currently sits at a range of 3.50% to 3.75%. This level was reached after a period of aggressive hikes designed to stop the high inflation seen in 2021 and 2022. Historically, the Federal Reserve prefers to move in increments of 25 basis points. A 150 basis point reduction would require either 6 standard cuts or several larger moves. Miran's proposal is at the lower end of the projections released by Fed policymakers in December. While most officials expect rates to move lower, there is a lack of consensus on the speed. Fitch Ratings recently adjusted its outlook, raising U.S. GDP growth estimates for 2025 and 2026. However, Fitch also noted that inflation might end 2026 at 3.2% due to factors like trade tariffs. This creates a complex environment for the Fed, which must weigh Miran's call for growth against the risk of inflation staying above the 2% target. The proposed rate cuts would have a direct impact on household finances. When the Fed lowers the benchmark rate, the cost of consumer debt generally follows. Mortgage rates often track long-term bond yields, which move in anticipation of Fed actions. A 1.5% drop in the federal funds rate could lead to more affordable home loans for buyers who have been priced out of the market. It also offers opportunities for existing homeowners to refinance high-interest debt. Regarding prices, the impact is twofold. Lower rates can stimulate demand, which sometimes leads to higher prices if supply does not keep up. However, Miran's argument is that inflation is already under control. If he is correct, lower rates would not necessarily trigger a new wave of price increases. Instead, they would simply stop the economy from slowing down too much. For the job market, lower rates are intended to be a stimulant. When it is cheaper for companies to borrow, they are more likely to invest in new projects and expand their workforce. This is a primary driver for the current administration's push for lower rates. They view the labor market as a priority and want to ensure that high borrowing costs do not lead to layoffs or a hiring freeze. Savings accounts and fixed income investments would see a different result. For the last 2 years, savers have enjoyed higher yields on certificates of deposit and money market funds. A 1.5% cut would significantly reduce the interest earned on these safe haven assets. This often pushes investors out of cash and into the stock market or other riskier assets in search of better returns. For businesses, especially small and medium-sized enterprises, the cost of capital is a major factor in daily operations. Many businesses rely on lines of credit credit with floating interest rates. A reduction in these rates provides immediate relief to their monthly expenses. This extra capital can then be used for inventory, equipment, or wage increases. This is why Secretary Bessent refers to rate cuts as a tangible benefit for regional economies. Analysts are closely monitoring three key indicators. First is the January 31st expiration of Stephen Miran's term. His departure may change the balance of voices within the Federal Reserve. Second is the upcoming inflation data for the first quarter of 2026. If inflation remains sticky or rises toward 3%, as Fitch Ratings suggests, other Fed governors may resist the 150 basis point target. Third is the influence of fiscal policy. The relationship between the Treasury and the Fed is being watched for signs of increased political pressure on monetary decisions. The degree to which the Fed maintains its independence will be a major theme for markets this year. For the average viewer, this suggests that the era of high interest rates may be nearing an end. If the 150 basis point plan is enacted, the financial environment will shift from restriction to neutrality. This is a time to evaluate debt and saving strategies. For those looking to make large purchases, such as a home or a vehicle, the latter half of 2026 might offer more favorable terms than the beginning of the year. However, it is important to remain cautious. Economic forecasts are based on current data, and unexpected global events can change the Fed's path quickly. Consistency in personal financial planning remains more important than trying to time the exact moment of a rate cut. The Federal Reserve operates through a system of 12 regional banks and a central board of governors in Washington. Each meeting of the Federal Open Market Committee involves a thorough review of regional economic reports, known as the Beige Book. This book contains anecdotal evidence from business leaders and community members across the country. It helps the Fed see beyond the raw numbers. Understanding this process helps explain why officials like Stephen Miran provide specific targets. They're attempting to project confidence into the market. When the market knows what to expect, it tends to be less volatile. Even when there are disagreements between governors, the public debate is a feature of the system. It allows for different economic theories to be tested against real-world data. As we move through the year, the Fed will continue to release minutes from their meetings. These documents provide a detailed look at the internal arguments for and against rate changes. Reading these reports allows for a deeper understanding of the complexities involved in managing the world's largest economy. The discussion around interest rates is a vital part of economic stability. At VeriScope News, we will continue to monitor the statements from the Federal Reserve and the Treasury to provide you with clear, context-driven updates. Thank you for trusting us for your news. We will see you in the next report.